Welcome to the podcast about investing in startups, where existing investors can learn how to get the best deal possible. And those that have never before invested in startups can learn the keys to success from the venture experts. Your host is Nick Moran, and this is the Full Ratchet.
Welcome back to TFR for another edition of Investor Stories. On this segment, the experts talk about a startup that failed and the causes of that failure. Here's the segment called Mortems. On today's special segment, we have Ryan Gembala of Pathbreaker. Ryan, can you tell us a story about a portfolio company that failed and why it failed?
Yeah, I would say the portfolio companies that have struggled are the ones that I've had two examples. One, platform dependency issue, just relying on Twitter and Facebook for data and users. Yep. That's the challenging position to be in. And then I think the other one that comes to mind, raised and spent too much capital before there was product market fit. And then valuation got set too high and it was hard to keep going. Got it.
How does that sort of change your process, if at all?
Well, it changes it a lot. So I find it very hard to invest in things that are dependent on the APIs of other people or, reliant on some other large company doing something that allows for their business. So we tend toward full stack type companies like Ironox that are fully autonomous indoor farms that control the end-to-end of their system. No platform dependency there. Companies that can be really capital efficient, addressable, has gotten to nearly 3 million ARR with less than $1 million raised, both robotics and robotic customer acquisition. So, finding founders that are at the pre-seed stage, being really mindful about cash and focus on customers is another tactic to hopefully avoid spending too much.
On today's special segment, we have Scott Dorsey of High Alpha. Scott, can you tell us a story about a portfolio company that failed and why it failed?
That's a good question. I would say maybe the way I would think about this, Nick, is I think we're early enough, thankfully. I'm not sure that we've had a portfolio company failure yet, but I would say the ones that are slower to gain traction are the ones that are just selling into tougher markets. Higher ed, always difficult. Selling into healthcare, selling into government, the slower sales cycles associated with those verticals and markets just take more patience and take more capital. So I'd say those have been the examples where the businesses have been slower to gain ARR traction, and you need more patience and actually more capital, to be able to work your way through multi-year sales cycles in some cases. Those are the ones that we're going to be most cautious about are, selling into markets where the decision-making process is slow. And I'd say it's probably why we're oriented more toward horizontal SaaS plays, and that's more akin to what we built at ExactTarget, are SaaS platforms that can go up and down the stack of SMB all the way up to enterprise, but also can cut across a lot of different verticals and also a lot of different geographies.
Yeah, and how do you think about that at the very early stages? So, early stage B2B SaaS company has a product that has applicability and applications in a variety of different segments, in a variety of different types of markets. How do you think about focus, picking a segment, understanding it, the sales cycles, decision makers, ROI, et cetera, at the early stages versus balancing that with, being opportunistic and selling into a variety of different potential segments?
Yeah, it's a great question. I think in the earliest stages, understanding your ideal customer profile is really important. And finding a wedge, what's the smallest amount of functionality one can build, to get in the door and deliver meaningful value. And actually, we debate all the time about, are we better off with a company that has a crystal clear value prop and a really sharp wedge into a market, but it's not clear how you increase the TAM over time, or the inverse of that, where there's a really big vision in place, but it's hard to know where to get started. I would say we've had more success starting small and then over time looking for opportunities to expand the market and expand how one can add more value to the end customer. So we do try to start with a clear definition of ideal customer profile and a real clear idea of where we can add value quickly, and then just have confidence that the more we partner with customers, the closer we listen to the users, the better opportunity we have to expand that opportunity over time.
On today's special segment, we have Elizabeth Yin of Hustle Fund. Elizabeth, can you tell us a story about a portfolio company that failed and why it failed?
Wow, so many. Not naming any names, but I think when I was earlier in my investing career, actually when I was at 500 Startups, a thesis that I had back then was, in this day and age, you can back teams that are not necessarily balanced teams. And I've since changed my opinion on that. But at the time, I felt like, the world has come to a point where if you are building something and technology is not really the core of it, if you're a non-technical founding team, then as long as you have hustle and the ability to bring in revenue, then you can build a great product. And there was a team that I backed that had exactly this. They actually had a fair bit in sales, but they just could not build product. They had sales, but they could not put that money to use to build a good product. And that was a problem. And so they were not really able to accelerate their sales because it was, they just couldn't make the product better. So I think, I've had my own learnings and changes over thesis, but I think it is really important to actually have a complementary team that kind of covers your basic basis, depending on obviously what the opportunity is.
And will you invest in a team that hasn't found maybe that CTO or head of engineering yet, but you feel like they're going to?
Well, I think it depends a bit in that I think in my mind, if it's a product that doesn't require either a lot of engineering or product chops, and there are obviously different categories of product, like Webflow requires strong product chops. You definitely need pretty much a lot of the founding members of the team to have that. But then there are other products, let's say, some, run-of-the-mill marketing automation software, maybe that doesn't matter as much. What I'm looking for is, even if you are not awesome at building yourself, can you even outsource and delegate and have the ability to do that? And that was something that this team that I mentioned could not do. Like they could not run an outsourcing process to do it. And this particular idea didn't require anything especially technical or product oriented, really. But I am looking for that now, even if the founders are not building the product themselves. And actually, just as a good example, the original version of Uber was built by a dev shop.
Really?
Yeah.
The black car version.
Yes.
I did not know that. On today's special segment, we have Jeff Fluhr of Craft Ventures. Jeff, can you tell us a story about an investment that failed and why it failed?
Yeah, I think probably, my biggest failed investment by far was my second company, not only because I put a bunch of my own money into it, but also I put a lot of my own time into it. So in a way, it was like really a double whammy. What we built at Spreecast was what we call the social video product. The product that we were building didn't exist before Spreecast, but it was sort of trying to take the social media products that people were familiar with, like Facebook or Twitter, and marry them with live video, like a Skype product, and kind of bring like face-to-face interaction into this kind of social world. And the idea, for me was, I felt when I started Spreecast, Facebook and Twitter were, already very successful companies that people, had huge user bases. And Spreecast was meant to be more authentic and kind of meant to like really put people together in a more face-to-face kind of way, where I felt like a lot of the kind of text-based sharing that happened on Facebook or Twitter, or even photos or even recorded videos, were oftentimes either polished or they were missing that kind of body language or facial expressions that are so important in human communication. I felt like, why aren't people like interacting face-to-face in the social media world? And at the time I started Spreecast, the technology was just coming on, where you could really have not just a one-to-one video chat like Skype had been doing for a while, but you could start to do larger group kind of video conversations, and you could start to do it in a web browser. And it was even really before it was on mobile devices. It wasn't until a couple of years after I was into Spreecast that really video on mobile devices became more of a feasible technology. And I think the problem and the reason it failed, I don't think there was really a market need or a market desire among consumers or among people to do that really, right? Like there was camera shyness. People felt much more comfortable, kind of thinking about their tweet and editing their tweet before they tweeted it, or kind of polishing their photo before they posted on Facebook. And they didn't really want to kind of interact with the kind of public or in more public forum kind of settings, in social media. And so I think it was just, a miss between what people wanted and the product we were building. And so I think that was the biggest issue. I mean, there were probably some other issues. And I think some of that, there have been other products since then, interestingly, that have kind of had similar ups and downs. So Meerkat was this sort of social live streaming mobile app. And then there was Periscope that got acquired by Twitter, which had a really reasonably good exit because they sold for $100 million before they even launched their product. But that product today, I don't think is, as big as people thought it was going to be. There's Facebook Live, but then there's also there was House Party, and I think House Party's had a huge resurgence now with COVID. So products that are more for private video chatting, like Zoom, which obviously, we know about, those products for private conversations have been very successful. COVID's been a huge bump for them. But more this kind of public forum discussion hasn't really taken off. There's this interesting startup right now that everybody's excited about called Clubhouse that just raised a bunch of money at a $100 million valuation, which I think is more just audio and not really video, but it's kind of has some similarities actually to what we built at Spreecast, except that Spreecast was video as well. So anyway, it's been an interesting space to watch kind of since I decided to wrap it up over there, because there's other people that are still trying things and still doing things that are similar. And I don't know that anyone's really nailed it yet. And maybe no one ever will, because of the reason that I think it may be sort of kind of against the grain of human nature.
That will conclude this installment of Investor Stories. If you're enjoying the program and would like to see it continue, take a moment and leave a 5-star review in iTunes. Also, if you'd like updates on new content from TFR, as well as the top 10 VC articles every week, go to fullratchet.net and sign up for the newsletter. Okay, that will wrap things up for today. Until next time, over-prepare, choose carefully, and invest confidently. Thanks for joining me.